Welcome back to the deep dive. We are jumping straight into one of the biggest geopolitical challenges facing Europe right now. How does the European Union actually plan to make Russia pay for the massive destruction in Ukraine? We're talking about a scale of money that is almost impossible to comprehend. Nearly 290 billion in immobilized Russian central bank reserves, and these funds are just sitting there, mostly in European accounts.
That's exactly the starting point. Our deep dive today is focused specifically on the European Commission's, well, it was a high-stakes attempt to turn this frozen wealth into immediate funding for Ukraine. The idea wasn't to just seize the money outright, not initially.
Right.
It was to use the principle of those reserves as, ironclad collateral to secure these huge loans. We saw proposals for around 90 billion, maybe even scaling up to 140 billion.
That sounds like a genius move. I mean, you weaponize the assets without technically confiscating them. So what went wrong? Why is the plan sitting on the shelf?
That's the mission right there. Our sources reveal exactly why that really ambitious collateral plan, it just crashed into a wall. And its failure exposed a really profound structural tension right at the heart of the EU project.
And this is where it gets surprising, because the resistance didn't come from a major political spoiler or some state arguing against solidarity with Kyiv. It came from a single country that faced, well, a disproportionate, almost catastrophic risk, Belgium.
You nailed it. By December 2025, EU leaders agreed to keep providing Ukraine with massive loans, but they decisively shelved that plan, the one to use the principal as direct collateral. The whole mechanism was just deemed unworkable, and that was primarily due to Belgium's legal and financial refusal to take on that concentrated liability all by itself.
This is fascinating because we tend to think of the EU as this monolithic bloc on foreign policy. If the goal benefits everyone, and it's about collective pressure on Moscow, why is the risk all focused on Brussels?
It all comes down to the plumbing of global finance, and to one single critical choke point: Euroclear Bank.
Okay, so tell us more about Euroclear. What is it?
Euroclear is one of the world's largest central securities depositories. You can basically think of it as a massive holding facility and settlement agent for financial instruments. Bonds, stocks, you name it. And the crucial thing, the most important piece of this puzzle, is that Euroclear Bank is incorporated in Brussels.
And our sources confirm it holds the lion's share of these frozen Russian assets.
A massive majority. The estimates are somewhere between 125 billion and 190 billion, all sitting in that one institution.
So, hold on. Because the bank is registered, incorporated, and regulated in Brussels,
Right.
all the legal heat, all the potential lawsuits, they fall exclusively under Belgian jurisdiction.
Exactly. When the EU decided to immobilize these assets, they didn't just vanish. They were legally quarantined inside Euroclear. So if the EU tried to monetize them, use them as collateral without a formal legal confiscation, Russia would absolutely sue. And those lawsuits would land right in Belgium's courts, making Belgium's judiciary the test bed for these totally unprecedented legal issues.
Wow. That puts Belgium in an impossible position. They're being asked to absorb a global geopolitical risk that should belong to the entire EU. And we know Russia isn't just going to accept this. Moscow has labeled any attempt to touch this money principle or the revenue as outright theft.
And that word theft is so important because it signals intent to retaliate.
It's a threat.
It's absolutely a threat. The moment the EU makes a formal move, you have to expect immediate, targeted legal attacks and counter-sanctions aimed right at Belgian financial institutions. But the risk goes way beyond Belgium's borders, especially for Euroclear itself.
Right. How does this challenge their core business model?
A place like Euroclear has to rely on the perception of absolute neutrality, sovereign insulation. Its clients are central banks, sovereign wealth funds, these massive institutions from all over the globe. If Euroclear is seen as having been weaponized, as actively using assets for political ends, it seriously damages its standing. Because non-G7 countries, or any country worried about future sanctions, will just accelerate their move to non-Western alternatives, like China's clearing systems, to protect their own trillions in assets. The cost of that loss of trust could bankrupt Euroclear, and that liability would land right in Belgium's lap.
It's a classic catch-22 for Belgium, and it's made even stranger by the financial incentive, right? While they are pushing back on the collateral plan because of the risk, Euroclear is actually making a killing from these frozen assets.
That's the bizarre profit paradox in all this. Because of European interest rate hikes, Euroclear has made billions. Our sources say they generated over $3 billion in interest profits in just the first 9 months of 2023, just from the interest. And Belgium is taxing that income. They were expecting around $625 million in tax revenue in 2023 and are looking at a massive $1.7 billion for 2024.
So on one hand, Brussels is taking in this huge, unexpected tax windfall from Russia's money. But on the other hand, it's shouldering all the legal risk if the EU takes that next step. That just sounds like a long-term strategic nightmare for a short-term tax boost.
It absolutely is. And that huge stream of tax revenue is actually, well, it's increasing Russia's long-term incentive to target Belgian institutions if the principle is ever leveraged.
The real insight here isn't just about Belgian banking law, is it? It's about what this tells us about the EU itself. The fact they couldn't execute this plan exposes a deeper structural issue. They want to project financial power, but they can't manage collective liability.
That's the fundamental failure of shared sovereignty here. This whole saga, it just spotlights the fragility of unanimity-based governance for these critical foreign policy decisions. It's governed by Article 29 of the Treaty on European Union, and that requirement hands enormous veto power to any single member state.
And we've seen this before, right? This isn't the first time.
No, not at all. You can point to recurring instances of pushback from states like Hungary under Viktor Orban. They've used this unanimity rule to delay or block sanctions packages or funding for Kyiv. But the resistance from Belgium here, it wasn't political blackmail. It was rooted in very real, quantifiable legal risk.
And the sources suggest that other major nations, Germany, France, the Netherlands, they got it. They saw the validity of Belgium's concerns.
That's the key takeaway. They saw this whole dispute over Euroclear as a proxy battle for burden sharing across the EU. They realized that if you're going to embark on this high-risk innovation, using frozen sovereign assets as loan collateral, it has to come with collective obligations. You just can't impose an existential risk on one member state to achieve a goal for the entire bloc.
So if the EU wants to be a real strategic player,
it needs a mechanism for collective indemnification. Simple as that.
And let's connect this back to the bigger picture. The EU is trying to do all of this while dealing with enormous global pressures.
Exactly. You have to see this debate through a lens of deep strategic anxiety. The EU is rearming at a rapid pace. It's grappling with escalating hybrid warfare.
Cyber attacks, disinformation.
Everything. It's also trying to reduce its dependence on Russian energy, and it's adjusting to serious doubts about reliable U.S. security guarantees long term. The institutional framework, burdened by this unanimity rule, is just struggling to keep pace with these soaring geopolitical ambitions.
Okay, before we get to the creative solutions they found, we need to clarify the legal firewall that Belgium was so worried about. Can you just define for us, for the listener, the difference between freezing and, say, confiscation, and what that means for sovereign immunity?
It's crucial we nail these definitions. So when we talk about freezing or immobilizing assets, that's a temporary measure. Ownership doesn't change at all. It just prevents the owner, in this case the Russian central bank, from moving or using the property.
And confiscation is the final step.
Confiscation is permanent. The final deprivation of property. Legal title gets transferred, usually after some kind of criminal proceeding, and that is the big legal jump everyone wants to avoid because it triggers the biggest hurdle of all, sovereign immunity.
Which sounds like a major international law firewall.
It's the biggest one. Central bank assets, what we call CBR assets, are generally covered by very robust immunity protection under customary international law. They're seen as instruments of the Russian state's sovereign authority, not as commercial assets. So confiscating the principal would be seen as a fundamental breach of state immunity, and that's a rule that protects all states, not just Russia.
So if outright confiscation is blocked, how did legal thinkers try to find a workaround? There must have been a counterargument.
There was. That's where the countermeasures rationale comes in. It's a highly complex argument, but the idea is that confiscation could potentially be justified as a third-party countermeasure in response to Russia's internationally wrongful act, the act of aggression itself. Basically, Russia broke a major rule, so the EU is legally entitled to take a countermeasure in response.
But I'm guessing that argument is filled with legal landmines.
Absolutely. The rationale involves huge legal risks. The core debate is whether these secondary rules, countermeasures, can legitimately override procedural rules, like sovereign immunity. And that legal ambiguity is precisely why Belgium was so terrified of being the testing ground for it all.
Okay, so given that confiscation was too risky for Belgium, what other sophisticated alternative was on the table to break that impasse and, distribute the risks?
The alternative was something called a lien-based approach, and it would be combined with a shared EU G7 indemnification scheme. A lien is just a claim or a charge against an asset as security for a debt.
How is that different from the original collateral plan?
The original plan was to use the assets as immediate collateral, which implies you're ready to seize them right away. The lien approach is conditional. It's a first priority claim. It would grant the EU or Ukraine a legal claim on the assets, but that claim would only be triggered if Russia failed to honor its reparations obligations after the war ends.
Ah, that makes sense. It preserves legality by making the seizure conditional on Russia's future actions. And the key part for Belgium.
The indemnification scheme. The idea was that the entire EU, and ideally the G7 partners, would jointly indemnify Euroclear and Belgium against any legal costs or Russian counter-sanctions. It shifts the liability from one country to a whole international coalition. It's a much smarter, more structured step.
But this lien mechanism is obviously complex and would take time to set up politically. The EU didn't wait around for that. They found a brilliant workaround using those massive profit that Euroclear was making.
That's the real operational victory in this whole saga. The move to target the profits, the interest instead of the principal. It was a separate process, and it was specifically designed to get around the unanimity challenges and that sovereign immunity firewall. The interest income is generally treated differently in law from the sovereign principal, which makes it much easier to seize legally.
And what's that money being used for?
The EU successfully agreed to channel the vast majority of that income. We're talking 90% of the net profits from Euroclear through the European Peace Facility, or EPF.
And for our listeners, what exactly is the EPF?
The EPF is the EU's off-budget instrument. It's designed to finance actions that have military or defense implications. Right now, its main job is funding lethal weapons and military equipment for Ukraine. So 90% goes straight to defense. The other 10% is earmarked for reconstruction.
So that successful use of the windfall profits is the immediate win. It gets aid flowing right now by working around those veto concerns.
It shows the EU's ability to innovate structurally when a direct political path is blocked. It's a slower, more methodical response, but it provides steady, high-value funding while the bigger fight over the principle continues.
So if we step back now, synthesize this whole picture, what's the core lesson that Belgium has taught the EU about its own strategic competence?
The core lesson is that Europe cannot build strategic competence or project power on a foundation of institutional instability or on unevenly distributed risks. Belgium's very specific legal and financial vulnerability became the pressure point that stalled the whole grand plan. The whole debate just underscores that fundamental tension between the EU's strategic goal to act like a decisive geopolitical power and its current institutional limits, especially that unanimity requirement.
So what does this all mean for the immediate future of Ukraine funding? The EU's strategy has clearly shifted away from that high-risk collateral plan.
It has. The strategy is now multi-pronged. First, immediately tax the interest profits, which is already happening. And second, develop more robust shared risk mechanisms. This includes things like the proposed Ukraine Loan Cooperation Mechanism, the ULCM. It uses macro-financial assistance loans guaranteed by the future flows of these profits. It's an admission that the slow, steady approach built on collective legal and financial obligations is just fundamentally safer and more sustainable.
We've spent this whole deep dive on the EU's moves, but let's end with a provocative thought, because the weaponization of finance is definitely a two-way street. What is Moscow doing right now to retaliate?
Russia is preparing for immediate reciprocity. Moscow has already adopted something called Decree Number 693. This decree sets up a fast-track mechanism to quickly auction off nationalized assets that belong to entities from unfriendly countries, so the U.S. and the EU. And critically, they tasked the sanctioned Russian bank, PSB, with organizing the auctions. This signals a rapidly escalating reciprocal financial war. Any move the EU makes, it could trigger a quick sell-off of Western assets inside Russia. It's creating this incredibly volatile landscape that foreign investors have to constantly monitor.